Hi guys, today we are going to discuss about intrinsic valuation. With this approach, you are basically valuing an asset based on its future cash flows. It is a fundamental way to approach valuation because it forces you to think in terms of business ownership and the benefit deriving from holding a stake in a company. In order to keep the length of the video manageable and understandable by everybody, I will avoid going too much into the nitty-gritty details and I will make some simplification. However, if you want us to delve in some of those aspects, please use the comments below. Furthermore, in case we reach 1000 subscribers, I will post also the Excel and the formula I use. So stay with me till the end, cause you're gonna learn how to value stocks like a value investor. Why do we perform intrinsic valuation? Basically, we want to determine if the price that Mr. Market is showing us today is cheap or expensive compared to its fair value. Basically, we want to determine how much the business is able to generate till judgment day in order to define how much it should be worth today. However, given that those cash flows are gonna be received in the future, and we know that the future value of money is different from the present value of money, we need to discount those cash flow back to the present time with a discount rate. This is why this approach is also called discounted cash flow or DCF. But using the two terms as synonym is not quite correct. In fact, the dividend discount model is the oldest approach in the intrinsic valuation, when equity investors were expecting to receive dividends as payment for their investment. However, given that not all company pays dividend, then the DCF was introduced next to the dividend discount model. However, the two approaches do not only differ in the numerator. Free cash flow for the DCF on one side, dividend for the DDM on the other side, but also in the denominator. In fact, given that equity investors expect to receive dividends, those have to be discounted back at present time with a rate of return which equals the minimum one that an equity investor expects to make out of the risk that is taking in the business, which is the cost of equity. On the contrary, debt and equity investors are interested in the free cash flow to the firm in the numerator, which then have to be discounted back with the cost of capital at the denominator.
In terms of precise calculations, but intrinsic value has come to be equated with, and I think quite properly, with what you might call private business value. Now, I'm not sure who was the first one that came up with it, but, well, the first one that came up with it was Aesop, actually. But the intrinsic value of any business, if you could foresee the future perfectly, is the present value of all cash that will be ever distributed for that business between now and Judgment Day. And we're not perfect at estimating that, obviously, but that's what an investment or a business is all about. You put money in and you take money out. Aesop said a bird in the hand is worth two in the bush. Now, he said that around 600 BC or something like that, but that hasn't been improved on very much by the business professors now. Now the question is, how sure are you that there are two in the bush? How far away is the bush? There are all kinds of things. What are interest rates? But I mean, Aesop wanted to leave us something to play with over the next couple thousand years, so he didn't spell the whole thing out. But that's what intrinsic value essentially is.
There are two fundamental ways to determine the cash flows. In case you are looking for cash flows to equity investor, then you have to look for dividends because you're going to apply the dividend discount model. On the contrary, if you are looking for cash flow to the entire business, then you have to look for the free cash flows because you're going to apply the DCF. We now have to tackle the first big question when dealing with DCF, meaning at which rate we will let this cash flow grow. Or said in another way, how much do we think the business is going to grow its free cash flow in the next 10 years? There are three fundamental ways to address this question. We can start by using external inputs, meaning looking at analyst report or at the management outlook of the company. Alternatively, we can estimate the company future growth by looking at how much the company is able to reinvest and the return on capital that is able to generate. Finally, we can look at the history of the company to understand how much it was able to grow in the past. The weighted average cost of capital is defined as the weighted average of what it costs the company to raise funds in the form of debt and in the form of equity, which are basically the two ways in which a company can raise capital. So, kicking off with the cost of debt, this is the cost at which a company can borrow money. It clearly depends on the level of interest rate prevailing in the market, which is basically the risk-free rate, and the default spread that the company has to pay on top of that, which depends from its rating and creditworthiness, basically. As regarding the cost of equity, the riskier the company, the higher my cost of equity has to be. To estimate that, we will use the capital asset pricing model, or CAPM, but there are also other models available you can use, like for instance the arbitrage pricing model or the multi-factor model. In the CAPM framework, the risk of an investment is seen as the additional risk to the market portfolio, which you can think of as a broad market index, like for instance the S&P 500. It has three fundamental inputs: the risk-free rate, the risk premium, and the beta. How much would you expect to receive if you are gonna sell the company after 10 years of cash flow projection? Or alternatively, how much would you expect to make from year 10 till perpetuity if you were to own the business forever? Addressing this question means finding the terminal value, the number that captures what is happening till judgment day. There are basically two approaches to address this question: the going concern or liquidation value, and the going concern. In a going concern, the terminal value is equal to the expected cash flow in the last period divided by the difference between the cost of capital and the growth rate. But you need to pay attention especially to the last figure, because this cannot be higher, for instance, than the rate of growth of the economy. To provide you with a real case example, I'm going to guide you now step by step through the estimation of the intrinsic value of a company. This is clearly an example run for academic purposes on historical data and does not constitute any financial advice. I have decided to look at yearly data, therefore each observation corresponds to the year-end data, and perform a DCF over a 10-year horizon. In this spreadsheet, I have downloaded the income statement, the balance sheet and the cash flow statement of Johnson & Johnson as of end of 2022. The figure reported are $1 million. So, starting with the free cash flow to the firm estimation, we first need to start from the EBIT, or earning before interest and taxes, which can be found in the income statement here, and then we drag and drop the formula like this. We then need the tax rate, which we can approximate as the ratio between the tax expenses that had been paid and the earning before taxes here. We then have to retrieve the depreciation and amortization from the cash flow statement on the very top. Similarly, the capital expenditure, or CAPEX, can be found in the cash flow statement. And finally, the change in the working capital can also be found in the cash flow statement. In particular, this is computed as the difference between the net working capital in a given year and the net working capital in the following year from the balance sheet, which had to be subtracted. The free cash flow to the firm are then equal to the EBIT times 1 minus tax rate plus depreciation and amortization plus the capital expenditure with the negative sign, or alternatively minus the capital expenditure with the positive sign, and minus the change in the working capital. So the first question that we need to address is the rate at which we will let this free cash flow to the firm grow in the next 10 years? Or said alternatively, how much do we think the business is going to grow its free cash flow in the next 10 years? We can look at the history of the company to understand how much it was able to grow. So let's compute the free cash flow to the firm yearly growth rate, the revenues growth rate from the income statement, as well as the EBIT growth rate from the income statement as well. We can then compute the 10-year arithmetic average, but next to that we can also compute the geometric average, which I always prefer to the arithmetic one, as it accounts also for the compounding effect. So we obtain a growth rate for the free cash flow to the firm, revenues and EBIT respectively equal to 6%, 3.5% and 4%. This is in my view a positive result, as it gives us already the idea of a stable company which does not face a lot of volatility between the top and bottom line of the income statement, as well as in the free cash flow. In deciding the growth rate, I personally prefer to stay conservative, as we are basically saying that the company will be able to grow in the next 10 years at the same rate. Also consider that except for the pandemic, we did not experience any significant market downturn in the past 10 years. So I decided to choose 2% as a growth rate for our free cash flow, but this is a judgment call that you have to make based on your assessment. Moving on to the weighted average cost of capital, we first need to determine the cost of debt. We start by looking at the total debt from the balance sheet, 38 billion, and the total equity, 77 billion, without the minority interests. Then we need to determine the cost of debt. Luckily, Johnson & Johnson issue regularly on the market, and thus it is quite easy to look at the yield of a 10-year bond maturity, which is equal to 4.5%. Finally, we need to determine the share of debt with respect to the sum of total debt and equity. In order to apply the CAPM, we need to look at the beta, which in our case is equal to 0.6%. To the market return, so the 10-year average of a market index, in our case I will use the average return of the S&P 500, 13%. And finally, as a proxy of the risk-free rate, I look at the yield of a 10-year treasury bond, 4%. So the cost of equity, thanks to the CAPM, can be computed as the risk-free plus beta times the difference between the market return and the risk-free rate, which is equal to 9%. So the weighted average cost of capital is equal to the weighted average of the cost of debt, so 4.5% times 33%, and the cost of equity, so 9% times 67%, which equals 7.8%. We start off by projecting the last free cash flow observed as of end of 2022, so 26 billion, and we apply the growth rate defined in the first step, so 2%. We drag and drop the formula till year 10. However, these are future cash flows, which we need to discount back at present time by using a discount rate, which in our case is equal to the cost of capital, 7.8%. We can compute then the so-called discount factor as 1 plus the discount rate, and then we need to block the cell to the power of minus the number of years in which we expect the cash flow to materialize, so -1, -2, and so on. The product between each cash flow and the discount factor return the discounted cash flow for every year. We now have to sum them up to obtain the present value of the free cash flow. We then need to determine how much Johnson & Johnson is gonna grow from year 10 till perpetuity. It is advisable, as said, to have a reasonable growth rate, which usually does not have to exceed the one of the economy. So in our case, I will assume that the US economy will be able to grow at a rate of 2%, so for Johnson & Johnson I'm gonna settle for 1%. Therefore, the terminal value of Johnson & Johnson is given by the expected cash flow of the last period, year 10, so 31 billion, times 1 plus the growth rate, 1%, divided by the difference between the cost of capital and the terminal growth rate, so 7.8% minus 1%. This gives us a terminal value of 468 billion or 221 billion in present value term, which we can then multiply by the 10-year discount factor. So the sum between the present value of the free cash flow and the present value of the terminal value return the enterprise value of Johnson & Johnson, which is equal to 414 billion. However, we are interested in the equity value of Johnson & Johnson and not in the entire enterprise value, because the listed stock price represents the equity value of a company. So to move from the enterprise value to the equity value, we need first the cash and short-term investment, which we can find in the balance sheet as the sum of cash and short-term investment and the total receivable of the last year, which give us 40 billion. Then we need the total debt, again from the balance sheet, which is equal to 38 billion. Then we need the preferred equity, which is 0 in our case, as Johnson & Johnson does not have preferred. And finally the minority interest, again from the balance sheet, and again 0. We now have all the ingredients to move on from the enterprise value to equity value by adding the cash and short-term investment and subtracting the total debt, which equals to 415 billion. In the balance sheet again, we can find the number of shares which we need to use to find how much a single share is worth. We do that by dividing the equity value by the number of shares, and in this way we obtain an intrinsic value of $160. So I would say we find a fairly valued company. So in my view, the intrinsic valuation approach is the best method to estimate the value of a company, because it forces you to think in terms of business ownership and to look at the fundamentals. However, there are some cons you need to be aware of. First of all, it is prone to emotional biases, because if you don't pay attention to the growth rate, you can basically justify any market capitalization. Then you need to pay attention to the assumption you are introducing, especially if you want to add complexity and level of details to your model. So for instance, if instead of defining the growth rate of the free cash flow like we did in our example, you want to model the evolution of the income statement, balance sheet and free cash flow through the entire estimation horizon by, for instance, starting from the top line, from the revenue, then you need really to introduce a lot of assumptions which are adding exogeneity to the entire model. Finally, you can use the intrinsic valuation and DCF in particular only for cash generating asset. So for instance, if you come with a question to value a Rolex or a Van Gogh with a DCF, I can't give you an answer. I really do hope you enjoyed today's video. And if so, please do not forget to subscribe to our channel. As said previously, if we reach 1000 subscriptions, in the description below I will include the Excel file I've used in today's example. So that's it for today. Cheers and see you next time.
When I break the lies, everybody wanna talk, but all I hear is lies.